All right, welcome to The Explainer. Today, we're going to break down one of the most fundamental yet super powerful concepts in trading, support and resistance. Think of these as the battle lines on any price chart, and really understanding them is the key to making sense of why the market moves the way it does. Now, the source material for this one makes a pretty bold promise, right? But honestly, the concept really is that intuitive. Once you start seeing the market this way, you can't unsee it. Okay, let's dive right in. So at its absolute core, what is the financial market? Well, it's just a giant tug of war. That's it. You've got the buyers on one side, they want to see the price go up. And then you have the sellers on the other, wanting it to go down. Literally everything else, it all flows from this one simple conflict. And that is where support and resistance come into play. Look, these aren't some kind of magical lines on a chart. They're just zones. Places where one of these two sides tends to group up and really show its strength. So you can think of support as the floor, that's where the buyers are dominant, and resistance, that's the ceiling, where sellers take over. Let's put it this way. Think of support like this. Imagine the price of gold suddenly tanks. It drops to a level that just feels like an unbelievable bargain. What's going to happen? Well, buyers are going to rush in, right? Demand just explodes. And that massive wave of buying stops the price from falling anymore and actually starts pushing it back up. That bargain price level, that's your support zone. Okay, so for resistance, just flip that idea on its head. Picture an entire neighborhood, every single person, decides to sell their house all at the same time. You've got this flood of supply hitting the market, but not nearly enough buyers. So what happens to the price? It has to go down. It's just forced down. That price point, right where the sellers totally overwhelm the buyers, that's the resistance level. Okay, but here's where it gets really interesting. Because, just knowing where these levels are, that's only half the battle. The real story, the real opportunity for traders, comes from understanding what it means when these levels actually break. Yeah, see, these levels, they don't hold forever. They're not walls of steel. And when the price just smashes right through one of these zones, it's sending you a huge, powerful signal. It's the market basically screaming at you that the balance of power has shifted and a whole new move is probably just getting started. So let's walk through it. What happens when resistance breaks? All right, so the price is moving up. It approaches that first resistance level, R1. The sellers, they're there. They try to push it down. But this time, the buyers are just too strong. They completely overwhelm the sellers and just punch right through. Now, what does that tell you? It's a huge signal of momentum. And now the price is free to run up to that next level of sellers, which is R2. And you guessed it, the exact opposite is true when support breaks. Buyers are trying to hold the line at S1, right? They're trying to defend that price. But the sellers, they are just relentless this time. And boom, the support cracks. This is a big sign of weakness. It's telling you the sellers are firmly in control now, and they're pushing that price down towards the next potential floor at S2. Okay, so this all makes sense in theory, right? But how do we actually find these zones on a real live chart? Well, it's actually way simpler than it looks. Let's break down how you can draw these battle lines yourself. Right, you don't need some complex mathematical formula for this. Not at all. All you have to do is train your eye to spot the obvious turning points in the price. We call these swings, and you can think of them as the footprints left behind from that battle between buyers and sellers we've been talking about. So a swing high, that's just a peak, is where the price was going up and then it turned around and went back down. That's a resistance point. That's where sellers jumped in. And a swing low is just a valley. The price was falling and then it turned back up. That's a support point where the buyers made their stand. These are the exact spots we're looking for. So the process is super straightforward. First, you just scan your chart for the most recent peaks and valleys, those swing highs and swing lows. Then you grab a horizontal line tool, or maybe a rectangle tool, and you just draw a zone around them. And I want to stress that word zone. It's really important to think of these as wider areas, not some razor-thin line. Why? Because the market's kind of messy, and that little buffer helps account for all the noise and volatility. Okay, so drawing these lines by hand is an awesome way to train your eye. You really start to understand the market structure. But let's be real. In the world of trading, speed matters. And there is a fantastic tool that does all of this heavy lifting for you. Yeah, you can automate this whole process with an indicator called pivot points. Pretty much any trading platform you use will have this built in. And what it does is really simple. It just takes the price data from the previous day, runs a quick calculation, and then
Bam! It automatically plots all the key potential support and resistance levels for the current day. Your S1, S2, R1, R2, they're all just right there, ready for you.
And you know what the biggest advantage is? These levels are totally objective. They're based on math, not opinion. And they're plotted on your chart before the trading day even starts. It's like getting a treasure map for the day that shows you where all the potential turning points might be. It just takes all the guesswork out of it.
All right, so we get what these levels are. We know how to find them either by hand or automatically, but how does this all become an actual actionable trading plan? What do we do with this information?
This right here, this is the classic game plan. The strategy is pretty simple. You look to buy when the price gets near a support level. Why? Because that's where other buyers are likely to step in. Your target for taking profits? Well, that would be the next resistance level up. And this is so important. Your stop loss, your safety net, goes just below the support level you bought at. And for selling, you just flip that whole logic around. But this framework does something else that is absolutely crucial. It defines your risk before you even enter the trade. You can literally measure the distance from your entry to your profit target and compare it to the distance from your entry to your stop loss. This lets you calculate your risk-to-reward ratio instantly, and that helps you decide if a trade is even worth taking in the first place. And that really is the power of using support and resistance. It gives you a logical framework for looking at the market, a clear way to define your risk, and a game plan that's based on high-probability zones. Knowing where these battle lines are drawn, that is the first and most critical step. The next step is learning to read the signals that tell you when it's the perfect moment to jump into the fight.